If you're looking to deploy capital into China right now, do you stick with the US ADRs you know, or do you head over to Hong Kong and mainland A-shares? This is easily the most debated question right now among allocators in New York and London. After a brutal multi-year correction, Chinese assets are flashing undeniable valuation metrics. China's growth assets absolutely crushed it in the first half of 2026. Star 50 skyrocketed 64% and Chinix jumped 35.6%, leaving markets like Germany and France in the dust. The IMF also bumped up China's GDP growth forecast to 4.6%, putting it at the top of the pack among major economies. And here's the kicker, the CSI 300 is trading at just 1.5x earnings, less than 43% of the Nasdaq's valuation, meaning investors could purchase safer assets at a much cheaper price. But the multi-trillion-dollar question for global macro investors remains, which vehicle offers the best risk-reward to play the rebound? Historically, foreign capital has used three primary pipelines to buy into China: US-listed ADRs, Hong Kong-listed equities, and mainland China-listed equities. While they all theoretically tie back to the same underlying macroeconomy, their regulatory landscapes, liquidity dynamics, valuation logic, and geopolitical risk premiums are entirely different beasts. Let's skip the fluff and break down the mechanics of each pipeline so you can choose the right tool for your portfolio. Let's start with the one most American investors know, ADRs. Why do Americans love Chinese ADRs? Simple. You trade them in dollars during US hours through your regular broker. No currency conversion, no foreign account, no AM earnings calls. Alibaba, PD, GD, you know the names. You read the filings in English. The SEC has your back. However, the structural thesis for holding US ADRs has fundamentally shifted. Yes, the PCAOB and Chinese regulators struck a deal in 2022 to allow audit inspections. Some companies got the all clear, but the Holding Foreign Companies Accountable Act is still the law. The political risk never went away, it just got quieter. This means you could wake up one morning to find your ADR suspended from trading, not because the company blew up, but because Congress and Beijing had a bad week. That's not company risk. That's sovereign event risk you can't hedge. The real tech titans Alibaba, Tencent, NetEase have already done a secondary or dual primary listing in Hong Kong. Capital is moving from New York to Hong Kong in real time. What does that mean to you? Thinner liquidity in the US and persistent ADR discounts. Same company, same fundamentals, but the US-traded ADR often trades at a structural discount to its Hong Kong equivalent because the smart money is already pricing in the migration. You're not just buying China risk, you're buying stuck in the wrong venue risk. Cattle, BYD. These are household names in global investing, and you can't buy them in the US. If your China allocation is ADR only, you're making a concentrated bet on a shrinking slice of the market. Pull these threads together, and the investment conclusion is unavoidable. If you are staying in ADRs purely for convenience, you are overpaying for geopolitical risk while locking yourself out of the massive innovation happening onshore. ADRs are fine for short-term tactical trading, but their status as a structural, core allocation vehicle has largely evaporated. Now let's talk about the door most serious investors are walking through. Hong Kong. The Hong Kong Stock Exchange is a mature institutional market. For a US investor, the operational setup is a seamless plug-and-play, T0 settlement, no arbitrary daily price limits, free capital mobility, and a currency pegged to the US dollar. Hong Kong's true alpha lies in its role as the ultimate cross-border liquidity node. It is the only financial marketplace in the world where mainland Chinese corporate savings, local Hong Kong capital, and Western institutional money freely collide in a single pool. Tencent, Xiaomi, Meituan, Sensatime, Baigin. If you want exposure to Chinese AI, robotics, biotech, and platform tech, Hong Kong is non-negotiable. Many of these companies are either HKEX only or have their primary listing there. This isn't about convenience, it's about access to the growth story. You can't build a modern China allocation without these names, and there's a structural reason they keep landing in this specific venue. Through Stock Connect, northbound capital flows into A-shares. Southbound capital flows into Hong Kong. ACEC sits at the intersection, a pressure valve for mainland money seeking offshore diversification, and a launchpad for global capital entering China. This translates to real liquidity depth and institutional-grade price discovery. You're not fighting against retail sentiment in a closed market. You're trading in a venue where global funds actually size up. But remember, as an offshore market, Hong Kong trades on China fundamentals and global dollar liquidity. Corporate fundamentals are tied to China's domestic economy, but liquidity is tied to the Federal Reserve and the US dollar index. When the Fed tightens, Hong Kong frequently falls into a painful liquidity trap, where rock-solid companies get aggressively mispriced simply because macro liquidity dries up. If ADRs in Hong Kong are China's glossy storefronts, the domestic A-share market is the factory floor. This is the onshore marketplace, packed with advanced manufacturing, clean energy, semiconductors, state-backed enterprises, and consumer staples. For U.S. investors, A-shares offer to things you can't get elsewhere: genuine diversification from U.S. equities and direct policy beta. First, genuine diversification. China A-shares exhibit incredibly low correlation with the S&P 500 and Nasdaq. Because the market is driven by domestic monetary cycles rather than global capital flows, it serves as an excellent portfolio diversifier to hedge against U.S. macro volatility. Second, policy-driven alpha. The Chinese government heavily subsidizes specific sectors like the EV supply chain, domestic semiconductor fabrication, and automation. A-shares allow you to invest directly alongside state industrial policy, where domestic capital concentration ensures strong structural tailwinds. Accessing A-shares is no longer an institutional hurdle. Though you can't open a mainland brokerage account as a non-resident, foreign funds can effortlessly buy in via Stock Connect or liquid US-listed ETFs. China is too big to ignore for most global allocators, but buying China through the wrong door can turn a decade-long growth story into a frustrating, underperforming trade. Stop trying to pick just one pipeline. For a sophisticated U.S. allocator, the optimal strategy is a portfolio approach. Use Hong Kong as a tool to scoop up heavily discounted tech giants that feature reliable cash flows and domestic backstops. Use Onshore A-shares as a structural growth engine to capture China's long-term industrial upgrade and policy-sheltered sectors. Finally, relegate US ADRs to a tactical, highly liquid trading vehicle for taking quick macro views or hedging portfolio exposure beyond the noise. Into the alpha. Subscribe to gain deeper access to investment insights.